Committee on Multi-Employer Pension Reform will come to order. Senator Hatch will be here in a moment. He asked that I begin, and I hope he's here by the time he can introduce the panel. So, and then if not, I'll introduce and we'll begin that, and Senator Hatch will make his opening statement. Thank you all for joining us today. Again, always, this is a third hearing of our Joint Select Committee on Multi-Employer Pension Reform. We know our job on this committee to find a bipartisan solution to the crisis threatening 1.3 million Americans and thousands of small businesses across this country. This job is essential. We know what happens, and I know this panel today will help us paint a picture of what happens if we don't do our jobs here. And this committee was put together to be as bipartisan as possible. In the end, as I think you panelists know, we need 5 Republicans and 5 Democrats to come to the table and support whatever this committee recommends. It's what Chairman Hatch and I have set out to do. I thank him for his work, and I thank all the members of this committee. I've spoken with all of you. I appreciate the seriousness with which each of you is approaching this task. Chairman Hatch and I decided from the outset to use this initial period to educate ourselves and our colleagues about this complex issue and the broad impact on people whom we serve. We've made real progress. This will be our fourth meeting, third actual hearing. We have 3 more hearings scheduled. We've assembled a committee staff made up of top people from the PBGC, the Department of Labor, and from offices here and staff here. The staff is working to provide us with the critical technical information the members of this committee require in deepening and broadening their expertise on the subject. Congressman Buchanan and I just spoke about more interaction among, formally and informally, among the group of us as principals. We're all open to that. In June, we're convening a dozen staff briefings, half of which have already taken place. We've received hundreds of comments online at pensions.senate.gov. One of our witnesses today came to our attention when he wrote into the committee. Thank you for that. As I said, we'll hold 2 more hearings in Washington, 1 more in the field, where the workers and business people and retirees will have the chance to weigh in. By the end of July, it will be time to take what we've learned through this process and get serious about the actual negotiations of an end product. It's what it will take to address this. We all have to put talking points and biases and political parties aside. We have to take what we're learning to craft a bipartisan solution. Senator Hatch and I are absolutely committed to that. Because as we'll hear today, not passing a solution to this crisis is simply not an option for our retirees, for our businesses, for the PBGC, for our companies, for our economy, for our country. It's not an option for the millions of Americans who are part of these multi-employer pensions. It's not an option for the millions more who will be affected if the system falls apart. It's not an option for the hundreds, actually thousands of employers and their employees whose entire business is at stake. We've heard a lot over the past year about the very real threat to retirees who paid into these pensions over a lifetime of work. Many have talked to many of us on this committee. I'd say all 16 of us have talked to retirees and heard their stories. It's because of their activism, and I absolutely credit them. Their activism, their refusal to give up is the reason this committee was created in the first place, and I applaud you for that. But the threat to current workers and to small businesses and our economy as a whole is equally real. If the multi-employer pension system collapses, it won't just be retirees who feel the pain. Current workers will be stuck paying into pensions they might never receive. Small businesses will be left drowning in pension liability that they cannot afford. And that will have ripple effects to our economy. Small businesses that have been in the family for generations, I hear from dozens of those in my state alone, could face bankruptcy. Workers will lose jobs as businesses forced to close shop. These businesses are already feeling the effects of this crisis. Uncertainty surrounding their future threatens their access to credit, their ability to invest in their own businesses, and their decisions about whether to expand and create jobs. That's why this issue cuts across party lines, across ideological lines through every region of the country. One of the reasons we've heard more from workers than from businesses is that retirees are more free to speak their minds. But we need to think about the plight of these small business owners, and this is crucial. If they speak publicly about fearing their business could go bankrupt, it would alarm their customers, it would scare their employees, and it might chase away their creditors. So I want to thank the witnesses here today for speaking for the thousands of small business people who think they can't. You represent businesses that by and large done everything right. These businesses join multi-employer pension plans to do right by their employees. They thought they were guaranteeing their workers a secure retirement, making their business an attractive place to work. They followed the rules set by Congress. They kept doing the work to make their businesses thrive. They kept contributing to the pension plan. Now these employers are being punished for succeeding where their competitors failed and for living up to their obligations when so many have walked away. Meanwhile, it was Congress that passed upside-down tax incentives and required insufficient premium levels. Congress allowed inadequate tools and financing for the PBGC. It was that government regulation that allowed this crisis to fester. It's our responsibility to clean up the mess Congress helped make. And that means more than the simple but an inadequate act of increasing PBGC premiums and marginally improving the minuscule PBGC guarantee. I don't oppose that, but that proposal is far too insufficient. Businesses and the groups that represent them all agree, saying saving the PBGC alone does not help anyone. Retirees will still see dramatic cuts to their pension. Workers will still pay into a retirement they may never see, and businesses will face increased PBGC premiums while a crippling liability still hangs over those businesses' heads. I'm confident we find a bipartisan solution that will solve this current crisis and improve and strengthen the system so it never happens again. I'm willing to consider, as I know Senator Hatch has told me this, willing to consider any idea that meets these goals. I will introduce the panel. Senator Hatch should be here in a moment, and we will begin the testimony. Our first witness is Chris Langen, Vice President of Finance at UPS. Mr. Langen began his 37-year career with UPS as a part-time employee, loading package cars at night. He spent the last 15 years working as the finance representative for UPS's union labor negotiations. He currently serves as a trustee on the Western Conference of Teamsters Pension Trust. He also serves as co-chair on the jointly trusteed UPS IBT full-time employee pension plan and the UPS Teamsters National 401k savings plan with combined assets of over $20 billion. Welcome, Mr. Langen. Thank you for joining us. Our next witness is Aaliyah Wong. Ms. Wong is the Executive Director at the Retirement Policy at the U.S. Chamber of Commerce. In this position, she's responsible for developing, promoting, and publicizing the Chamber's policy on employer-provided security plans, non-qualified deferred compensation, and Social Security. Welcome, Ms. Wong. Thank you for joining us. Our third witness is Mary Moorkamp. Ms. Moorkamp is the Chief Legal and External Affairs Officer and Corporate Secretary for Schnuck Markets, Inc. Thank you for joining us, Ms. Moorkamp. And our final witness is Mr. Burke Blackman, President, Egger Steel Company in Sioux Falls, South Dakota. Founded in 1946, Egger Steel is a third-generation family-owned steel fabricator that serves the upper Midwest. Mr. Blackman joined Egger Steel Company in 2002 as Vice President of Operations. He served as Vice President of Finance before becoming President. He has several years of finance experience in the securities trading, mutual fund, and venture capital industries. Welcome, Mr. Blackman, pending the chairman's arrival. Okay. He is 1 minute away, and I will wait till he makes his opening statements, and then Mr. Langen, you can proceed. But hang on a second.
Sorry I was a little late here. Well, I just say good afternoon and welcome to today's hearing. Today we continue our informational hearing on the multi-employer pension system. We brought in business representatives to provide their perspectives on issues with the defined benefit system in order to better understand the realities employers face participating in the multi-employer system. We will delve into some fundamental questions, including why employers entered into collective bargaining contracts to participate in these plans to begin with, how participation affects a business's ability to operate as a going concern, and how the financial condition of these plans affect their ability to access credit, invest in new facilities, equipment, expand operations, and hire new employees. Before I proceed, I want to provide a brief update on the activities of the Joint Select Committee. The committee is operating on several tracks. We have the outward-facing process of the hearings, which have been useful to better understand the issues confronting the committee. Committee staff have also held a number of briefings on a wide variety of technical issues in the multi-employer area, including topics that will be touched upon today, such as the impact of withdrawal liability and the operation of the bankruptcy laws in the multi-employer space. The committee is also working on a range of possible policy options for review. As we continue to develop and evaluate these options, working with the PBGC, our in-house experts and other agency officials to put some flesh on the bones of these ideas will rely on them. I remain open as to what the committee may consider later this year, and my co-chair, Senator Brown, has, and I'm grateful he started this off on time, has similarly expressed openness. I also know that there are members of this committee who are actively working on proposals which they may put forward after fully analyzing their ideas. But with all of that said, there remains a lot of work to do. And I think I should be clear that I do not see our choices as being limited to a referendum on some sort of loan program. I bring this up because some prior comments have indicated to me that some of my friends have become convinced that we are stuck with a loan or nothing choice. I have few thoughts about that. First, some of us have genuine concerns and questions about the nature of the proposed loan programs, which have yet to be fully analyzed. And a major question remains, what is the limiting principle on risk to the American taxpayer? Multi-employer plans are private arrangements between employers and unions covering wage compensation and fringe benefits. Yes, they are shaped to some degree by the tax and pension laws, but so are defined contribution plans and other pension arrangements, as well as a whole host of other financial arrangements in the private sector. It is clear that the employer and union participants entered into these contracts with an understanding of the terms and conditions that should have allowed them to manage these obligations in a way that would ensure their financial viability. And although federal actions over the last 50 years have helped shape where these plans stand today, the arrangements are at their core privately bargained for contracts negotiated without the federal government's input. And candidly, the vast majority of federal taxpayers have no financial interest in these plans. So let's be diligent and methodical as we approach these issues and negotiate solutions. I want to be sure we create that we're mindful of all of the consequences of our approach, intended or not, so that we can prevent future failures, mismanagement of taxpayer dollars, and the economic dangers of moral hazard. We need to learn from our mistakes and do better here. Now, none of what I am saying is to dismiss the real concerns of participants, including active workers and retirees who face real hardship as these plans decline and even fail. As a former skilled union member, and I did learn a skilled trade, and practiced it as a full journeyman, I understand these perspectives, and I recognize that the difficult but necessary choices we have to make as this committee will affect real people with real families. But I also know that real people who are currently employed and paying taxes are also affected by the decisions these businesses have to make. And the difficulty businesses encounter because of the current condition of these pension plans is sometimes bizarre, if not ludicrous. As just one example, it is alarming, as we will hear today, to learn that the estimates of withdrawal liability frequently exceed the book value of the sponsoring companies. And as some companies will testify, there is a real fight to get out from underneath the burdens of pension liability for employees who were never even employed, let alone receive a pay packet. It is truly a complicated issue, one that requires us to move thoughtfully instead of jumping to conclusions to score political points. That's why I look forward to exploring these issues in depth today and beyond. And I'm pleased by our witnesses today who will share with us their views on these matters. With that, let's get going with the testimony. I'm glad that Senator Brown has done such a good job and introduced all of our witnesses here today, so we'll just begin
Mr. Langen,
with our witnesses.
Thank you. Thank you, Art.
Good afternoon. My name is Chris Langen. I've been with UPS for 37 years, and I am currently a Vice President of Finance. I would like to thank the committee for the opportunity to speak with you today. Over the past 15 years, I've been deeply involved in the multi-employer community as a trustee and advocate for legislative change. As you have heard in previous testimony, multi-employer pension plans are critically important to over 10 million American participants and thousands of contributing employers. The challenges facing multi-employer plans are not new. Since the tech bubble in 2002, the system has been strained, and the 2008 recession compounded their demographic problems. The Bipartisan Pension Protection Act of 2006, or PPA, included the creation of the green, yellow, and red zones, and for the most part, worked to stabilize the system and cure funding issues. Unfortunately, no one predicted the market declines of 2008. We are here today to find solutions for troubled plans that work for all the parties involved. The issue can be broken down into a few buckets: negative cash flow, the PBGC's role, withdrawal liability pressures, and lastly, the contagion effect. These plans simply have a math problem. Negative cash flow in critical and declining plans cannot be fixed by investment returns or increased employer contributions alone. As the PBGC Executive Director, Mr. Thomas Reeder, testified before this committee, these plans need a cash infusion now to remain viable. Some have argued that employers can just increase their contributions to provide the necessary funding. The problem with this idea is that critical and declining plans do not have an employer base that can handle their higher contributions. Raising contributions to the point of unaffordability will cause already struggling employers to go bankrupt and reduce the employer base further. Since the enactment of the PPA in 2006, most employers have seen their contribution requirements more than double. That leads me to my second point. The PBGC has estimated its unfunded liabilities at over $65 billion. Many feel that the PBGC's impending insolvency can be addressed with a significant increase in premiums. As Mr. Reeder testified, the agency needs $16 billion over the next 10 years just to survive. While increasing premiums to the PBGC sounds logical, it can have unintended consequences. The premiums are an administrative expense that's assessed to the plans on a per-participant basis. The catch-22 is the plans pay premiums on all participants whether they have an active employer or not. Thus, the amount of the increases needed puts further strain on the plans and ultimately the few remaining employers. We believe a solution exists where financial assistance can be provided to the plans under a structure where it will be paid back in full. Under this structure, plans will not need to turn to the PBGC for assistance. Premiums will not need to be increased over 800% as estimated by the CBO to keep the PBGC solvent, and retiree benefits will not need to be slashed 50 to 70%. The other dynamic we cannot ignore is the potential withdrawal liability that companies face in these plans. In many cases, it is more than the value of the company. The small business owner participating in the MEP system cannot sell their business or leave it to their children. The potential liability is impacting companies' ability to borrow money and grow their business. Banks and investors are not stepping in because in many cases the contingent liability is greater than the value of their company. This leads me to my last point today. The contagion effect between healthy and unhealthy plans is real. When plans become insolvent, they will impact the financial health of a well-funded plan. Like many employers, UPS participates in multiple plans across the country with many of the same employers. I would like to pause and ask you to take a look out over the room. Now imagine half of the room is empty. The half of the room that is gone also participates in many different plans. The impacted plans have just lost a significant portion of their contribution stream. The contagion effect has occurred right in front of your eyes. The failure of these troubled plans will continue to put pressure on the remaining contributing employers, the participants, and the PBGC. Some may be skeptical of this scenario, but the one fact you cannot argue is that once a company is gone, they are no longer making contributions to any plan and have left their liabilities behind. Is this a risk worth taking? In closing, we think there are viable solutions that can save these troubled plans. Generally, we believe long-term low-interest rate loans are a viable solution and would stop the plans from selling assets to pay benefits, giving them an opportunity to regain their financial strength and repay the loan in full over time. We believe there are ways to provide assurances that the loans can be repaid so the taxpayers are protected as well. Letting the system fail will increase individuals' reliance on other government programs. The committee has an opportunity to responsibly solve a serious problem in a bipartisan fashion. Thank you again for the time to testify today. We look forward to working with you in the future.
Well, thank you for your testimony. Ms. Wong, we'll turn to you.
Good afternoon. I would like to thank the co-chairs and all members of the committee for the opportunity to testify in front of you today on the employer perspective and multi-employer plans. I am Aaliyah Wong, Executive Director for Retirement Policy for the U.S. Chamber of Commerce. Chamber membership includes numerous contributing employers to multi-employer plans, and as such, the Chamber has been engaged in various legislative efforts to reform the system. Despite the best intentions of this legislation, the multi-employer pension crisis remains. At the end of 2017, the Chamber issued a report that provides an overview of the current crisis. Today, the Chamber issued a subsequent report, the Multi-Employer Pension Crisis, Businesses and Jobs at Risk, and we ask to have this report entered into the record. This report underscores the risk to contributing employers, and those are the risks I wish to discuss today. To be clear, the risk to businesses includes employers not only in declining plans, but also in healthy plans. And the job risk impact not only union employees, but also non-union employees. Moreover, this is not a future crisis, it is a current crisis. Employers and workers are being impacted today, and it will only get worse the longer we wait. Contributing employers are currently suffering under a number of burdens: withdrawal liability estimates that exceed the value of their businesses, exorbitant partial termination withdrawal liability assessments, and high contribution rates. These burdens are resulting in less optimal lending rates and even the denial of credit, the inability to expand business operations, problems with employee retention, and in some cases, the closure of the business. The multi-employer crisis is today, and today it is detrimentally impacting employers' abilities to efficiently run a business. Once we start to see additional planned insolvencies in the future, these problems will multiply. Here, I would like to stress the uncertainty of the situation. While there have been planned insolvencies, there has been nothing on the scale of what will happen if Central States and the Mine Workers Fund goes insolvent, and we definitely have not experienced an insolvency of the PBGC. This uncertainty is paramount. Contributing employers can try to make plans, but in reality, there are various scenarios that are out of their control and could have a devastating effect on their business. In testimony before this committee, the PBGC suggested that an insolvent plan may never terminate, and employers could instead continue to make ongoing contributions to the plan. While continuing to pay contributions in an insolvent plan may save an employer from short-term economic disaster, it is doubtful that an employer can endure such high pension contributions over the long term. Instead, these high contributions in perpetuity could lead to the closure of the business, filing for bankruptcy, or both. On the other hand, if an employer decides to withdraw from a plan, it might find itself part of a mass withdrawal if all the other employers also decide to withdraw. Liabilities determined under a mass withdrawal are higher than in a standard withdrawal, and there is not a 20-year cap. Therefore, this unexpected and expanded liability could cause a business to end up in bankruptcy. Further uncertainty surrounds the minimum funding rules in an insolvent plan. Plans in critical status that adopt a rehabilitation plan are exempt from the minimum funding rules and corresponding excise tax. However, it is unclear how or if these rules will apply if there is a major plan insolvency or the insolvency of the PBGC. It is possible that the IRS and the PBGC could take an aggressive approach and reinstate the minimum funding rules and the excise taxes. Because the rules are unclear, employers that continue to contribute in accordance with its rehabilitation plan post-insolvency could be required to make up a funding deficiency and pay excise taxes, potentially putting the employer out of business. Finally, I would like to discuss the contagion effect. As mentioned, because employers contribute to more than one multi-employer plan, there is a valid concern that the failure of one plan, particularly a large plan, could cause other plans to go insolvent. Further, a plan insolvency could cause an employer to go bankrupt and therefore not able to make contributions to other plans, causing those plans to go insolvent as well. In addition, the bankruptcy of one large employer could also trigger a string of plan insolvencies. These scenarios are very likely in critical and declining plans, in particular, where in a number of them, over 80% of the contributions are made by only one or two employers. I would be remiss if I did not mention there is a growing concern from healthy plans. While the focus has understandably been on critical and declining plans, it is also necessary to keep healthy plans healthy. As such, we need a comprehensive solution that addresses the entire multi-employer plan system. These are difficult issues and the answers are not easy. However, if we do not find an immediate and comprehensive solution, there will be a devastating impact on businesses, jobs, and the entire multi-employer plan system. Thank you for the opportunity to testify, and I look forward to your questions.
Well, thank you so much. Senator Brown and I have to go vote, but Ms. Morskamp will take your testimony, and then when she's finished, we'll...
And all 7 of us from the Senate will be gone for probably 20 to 30 minutes. So we have your written testimony, Ms. Moorkamp and Mr. Blackman, and we will return.
So we are taking notes, and we'll go straight...
Congressman Neal, I believe, is going to preside from
Yeah,
our
we'll go straight across the board, and you'll have presiding over here, and Ms. Fox will help us.
Thank you, Mr. Chairman.
Okay.
So we'll proceed with the testimony as offered. Ms. Morskamp?
Co-Chairman Hatch, before you leave, Co-Chairman Brown, and members of the Joint Select Committee. I'm Mary Moorkamp.
Would you put your mic on, please?
Is that better? Is that better?
Yes.
My name is Mary Moorkamp, and I'm the Chief Legal and External Affairs Officer for Schnuck Markets, based in St. Louis, Missouri. Thank you for the opportunity to testify before you today. My message today is simple. This committee must succeed in its mission to solve the multi-employer funding crisis. The consequences of failure are real and significant, not only to retirees, but to employers, employees, and our local communities. To quote from the movie Apollo 13, failure is not an option. Schnucks is a third-generation, family-owned retail grocery chain. We were founded in Anna Donovan Schnucks' kitchen in 1939 as a way to feed her family and neighbors during the Depression. Nearly 80 years later, we have more than 13,000 teammates in 100 stores across 5 Midwestern states. We are proud of our local heritage, and our mission of nourishing people's lives goes beyond selling groceries. We focus on promoting health and wellness, supporting human services such as workforce development, and reducing hunger by partnering with food pantries to provide almost $12 million in food annually to help feed those who might otherwise go without. I want to turn to the multi-employer funding crisis and how it could jeopardize employers. While my comments focus on central states, the PBGC says about 130 funds are projected to go insolvent within 20 years. Schnucks entered central states in 1958. This was more than 15 years before Congress enacted ERISA or the withdrawal liability rules. So it's not that we made a bad deal. Rather, the rules were changed on us after the fact. Our contribution rate when we entered central states was $3 per week. Since then, our contribution rate has increased 114-fold. Our contribution rate today is $342 per week, which is nearly $18,000 per participant per year. According to Central States, 59% of the retirees in the plan are orphans, meaning their contributing employer no longer pays into the fund. 54% of our contribution dollars, or $185 a week, go to pay benefits of participants who never worked for Schnucks. When an employer leaves the fund, the unfunded liabilities of its participants shift to the remaining employers. This drives up our contribution rates and means that the responsible employers who followed all the rules are the ones left holding the bag. The unfunded liabilities also create a staggering withdrawal liability. Of our 13,000 teammates, about 200 participate in Central States. According to Central States, our withdrawal liability for these 200 participants exceeds $281 million. This averages to $1.4 million per Teamster participant. While we expect to pay less, it makes no sense for a company who has made every required payment for 60 years and seen its contribution rate increase 114-fold could have a withdrawal liability that even approaches this amount. One question I hear is, well, why does Congress have to deal with this now as opposed to 2025? Well, I'll show you why. First, we're reluctant to grow our business. For each new store we open, we have to hire a driver who must go into Central States. And by our calculations, each new driver that we add increases our withdrawal liability by $200,000. Second, we face recruiting problems. Prospective drivers know what's happening in Central States, and they want no part of it. Third, there are business decisions that make complete economic sense that are not being made because of withdrawal liability rules. And fourth, lenders, rating agencies, and auditors are becoming increasingly concerned about the impact of Central States insolvency. This impacts our credit rating and our cost of capital. These are issues we face today, not 2025. What I've described is the Schnucks story, but I suspect that you're hearing similar stories from your local employers. There are about 5,400 employers that contribute to plans that are heading towards insolvency. The future for many of these employers is very uncertain if the plans go insolvent. So what tools should the committee consider? The multi-employer rules date back nearly 40 years, and they have not kept pace with economic changes. The rules need to be reformed. But first and foremost, this committee must focus on measures to stabilize the patient before it can cure the patient. These 130 plans face a math problem, and no realistic, sustainable level of increased contributions, investment returns, or benefit reductions will solve the problem. The unfortunate reality is the math doesn't work without a long-term, low-interest rate federal loan accompanied by sacrifices by all stakeholders to reduce the cost. And the loan program must be implemented quickly and structured in a way to ensure its repayment. Developing a solution won't be easy, and if structured fairly, all the stakeholders are going to dislike parts of it. But again, failure is not an option. Thank you again for the opportunity to appear before you today, and I'll be happy to answer your questions.
Thank you very much. Mr. Blackman.
Good afternoon, members of the Joint Select Committee on Solvency of Multi-Employer Pension Plans. Thank you for the opportunity to speak with you today about a topic that has significantly impacted my business. I'm the president of Egger Steel Company, a third-generation family-owned business located in Sioux Falls, South Dakota. We currently have 51 employees, 34 of whom are hourly shop workers. On their behalf, we contribute to the Boilermaker Blacksmith National Pension Trust. We've been contributing to this pension since 1971. We first became aware that the Boilermaker Blacksmith pension had an unfunded liability when we were notified that our company's 2002 withdrawal liability was over $900,000. Prior to that notification, we had never heard the term withdrawal liability. Our most recent valuation indicates a withdrawal liability of approximately $2.1 million, or over $60,000 per active eligible employee. What impact does this have on my company? The short-term impact is that it increases my shop labor costs. In order to attract and retain employees, I have to offer competitive take-home wages. Younger employees are cynical about the value of their pension benefits, so they will leave my company for a non-union competitor if their paychecks aren't equivalent to what they could receive somewhere else. The problem is that while my non-union competitors are offering between 3% and 6% 401k contributions, the equivalent rate for my company's total pension contribution is 14%. My shop labor costs are therefore 8% to 11% higher than my non-union competitors because of the underfunded pension. The long-term impact of this crisis is related to my company's withdrawal liability. While my competitors are purchasing expensive new technology to improve their productivity, I am limited to fixing or replacing broken equipment because at any time, my withdrawal liability could skyrocket like it did in 2008. The pension could impose steep increases in contribution rates, or if too many employers withdraw from the pension, it could fold and assess withdrawal liabilities on whichever participating employers are left to absorb its losses. While it is true that if a withdrawal liability were to be assessed, I could pay the liability at the same annual rate that I've been making contributions, in reality, I would incur the additional cost of contributing to a new 401k account for those employees who would no longer be earning a pension benefit and would otherwise leave my company for a competitor that does offer retirement benefits. Instead of my labor costs being 8% to 11% higher than my competitors, they would now be 13% to 16% higher. The multi-employer pension crisis is serious, and it's getting worse every day because the pension plans are still making new defined benefit commitments without collecting enough contributions to cover their true costs. Before we do anything else, we must recalculate the true extent of the problem using realistic actuarial assumptions. I'm not suggesting that all multi-employer pension plans should immediately recast their projections. Doing so risks a cascading failure in which weaker companies will fold under the pressure of higher contributions or higher withdrawal liabilities and will dump their obligations onto a shrinking number of survivors. This committee, however, should independently determine the realistic funding status of these plans to ensure that any solutions offered do more than just kick the can down the road for a future Congress to address. My second recommendation is to transition orphan beneficiaries to the Pension Benefit Guaranty Corporation. The last man standing provision of multi-employer pension legislation was a mistake, and correcting it would eliminate the risk of cascading failure. The PBGC would require additional funding to support these orphans, which could come from higher premiums or from transferring proportional assets from the orphans' former pension funds to the PBGC. In either case, the PBGC should consider the funding status of the affected pension plans and vary the premiums or funds collected to avoid harming significantly underfunded plans. My third and final recommendation is to stop making new defined benefit commitments. In my company's example, instead of paying 14% of wages to the pension, I would propose to redirect 5% to a defined contribution plan for all new hours worked and continue contributing the remaining 9% to the pension until its unfunded liabilities are paid off. The pension may require federal loans to satisfy its short-term cash flow needs, but if it stops making new commitments while continuing to collect contributions, it will eventually be able to pay back its loans. If it would take the pension 50 years under this scenario to pay off its liability, then perhaps we need to consider current retiree benefit cuts or direct taxpayer assistance. But before we do either of those things, we need to admit that the era of defined benefit retirement plans is over. On a closing note, I'd like to mention that I've listened to all the previous committee hearings and am aware of 3 proposals made thus far: loans, bankruptcy law changes, and hybrid pension plans. I believe that each of these proposals has some merit, but as a small business owner, I have concerns about all of them that I would be happy to share, and I welcome your questions.
Thank you very much. I think the panel offered an encapsulating view of what the challenges that we all face, and Ms. Fox, I know, has an obligation on the floor, so I'm going to recognize her first.
Thank you very much, Congressman Neal. I want to thank each of you and the employers you represent for being here today to share your perspectives and your stories with the members of this select committee. I especially want to thank the representatives of UPS, Schnuck Markets, and Egger Steel. It takes a lot of courage to put your company's story out there in a setting like this, but it is important and necessary in order for all of us on this committee to get the full picture. So thank you. I want you to know we're listening, that I understand the issues you're facing, and understand the importance of finding a fair, fiscally responsible, and forward-looking solution to these problems. Ms. Wong, I have a question for you. Which of your member companies have made the difficult decision to withdraw from a multi-employer pension plan in the last decade. Are there common factors that went into company decisions to leave the plans?
Thank you. So there have been a number of members that have decided to withdraw. I, for their purposes, won't give their names, but the main decision has been they have looked at the liabilities they're facing now versus the liabilities they might face later, and whether they could afford to pay those liabilities now. A number of employers have looked at that and have determined that they can't make that decision now, and so they are staying in the plans, which adds to the crisis and makes it even something more that we need to worry about.
So when determining contribution amounts to a multi-employer plan, do your member companies aim to fully fund the plans in which their employees participate, or do they instead aim to meet the minimum contribution amount required by their respective collective bargaining agreements? And do you believe employer contribution amounts are sufficient to provide plan stability?
So our members aim to meet the requirements of the collective bargaining agreement. That's what they negotiated, and that's what they expected to pay. In terms of the amounts, they look to plan professionals to figure out exactly how that works. That's what we look to at the chamber as well. So all of our employers aim to fulfill their commitments. All of them aim to be able to provide benefits. I think it was mentioned, the rules of the game have changed. There have been outside factors that have weighed in as well that have made that more and more, or made it harder for them to do.
Thank you. Mr. Blackman, very quick question. Boards of trustees for multi-employer plans are made up of union and employer representatives. As a small employer in a large plan, do you find the interests of your employees are well represented by the trustees?
Let me answer this without implicating anybody unnecessarily. We are a small employer, and I would answer the question this way. Since our company's founding, we, to my knowledge, have never been invited to express an opinion to the Board of Trustees of the Boilermaker Pension. The communications that we receive from the pension are the legally required communications. We do not vote on the trustees. We've never been asked to vote on the trustees. To my knowledge, the employer trustee representatives must elect themselves because we don't elect them.
Thank you. I yield back, Mr. Chairman.
Thank you very much, Ms. Fox. Just a couple of thoughts. I've been here for a long time. I think that we need to be reminded, because I do have a loan program out there that's been well met. It's bipartisan in the House. We have Republicans and Democrats who have signed the legislation in the House. And with a long memory, I would point out that I got here not to create the S&L problem, but to be part of the solution. And there was an awful lot of money borrowed to get many of those S&Ls out of the problem that they had. In this instance here, there's a different distinction now. And the distinction here is that there's been really no bad decision-making. These have been events that have gone around the pension plans that have created part of the problem today. And I don't have to remind everybody about what happened here in 2008 when we had a series of controversial votes. There was a plan that was endorsed by, at that time, candidate Obama, candidate McCain, when they were invited to the Oval Office to discuss a Wall Street solution in which much of the money was borrowed. And I think calling attention to those precedents is really important. We're not suggesting that, as one of the witnesses has said, that that's the only solution. What we're saying is that that needs to be at least part of the conversation as we go forward. Now, everything has changed over these years, and the financial crash dealt many of these plans a huge financial blow. And now, with pension plans in every state in the country in jeopardy, millions of retired workers are facing a financial nightmare. Cuts to their hard-earned retirement savings are occurring through no fault of their own. The reality also is that most employers that contribute to multi-employer plans, including representative companies that are here today, have tried to do the right thing. I think that that needs to be emphasized as well. Deregulation in the 80s and the early 90s, as well as large-scale economic downturns in 2001 and 2008, led to waves of industry-wide employer insolvencies. And the remaining employers in these plans are now the last man standing in their respective multi-employer plans. To address this crisis, Senator Brown and I did introduce legislation last year that we hoped would kick off the conversation. It included a loan program. The money for these loans and the cost of running the program would come from the sale of Treasury-issued bonds, to financial institutions, and I have already established a precedent with those who would purchase the bonds. The Treasury Department would then, as I noted, sell those bonds in an open market to large investors, and those financial firms would then lend money to the plans for the sale of the bonds to financially troubled pension plans. I think that this is a program that offers a common-sense solution. In the private sector, they have acknowledged this as well, and they have been generally supportive, if not specifically, to the concept that we have offered. Mr. Langen, UPS has advocated in favor of a loan program to address the multi-employer pension plan. Ms. Wong, the U.S. Chamber of Commerce has released a series of principles on addressing the multi-employer crisis within these principles, and the U.S. Chamber has also endorsed a loan program. Could I hear from the two of you as to your notions about loan programs?
Yes, thank you. We feel that a loan program is necessary at this point. We have been discussing a loan concept over the last 2 years in trying to resolve this issue because the plans need cash flow. We've got to stop the cash flow that is coming out the back door compared to the contributions that are coming in the front door. And unfortunately, 2008 brought their asset base down on all of these mature plans that are in declining status to where they can't earn their way out of it. And in a mature plan, your asset base really becomes a contributing employer because of the yield coming off those assets. You get a much different yield on $30 billion than you do $15 billion. So the cash flow is the problem in the plans, and a loan, a low-interest loan would solve that problem, and we have to ensure it's paid back.
Ms. Wong?
I agree with everything that was said. From the chamber perspective, again, there have been increased employer contributions. We've seen active employees, their benefit accruals have been cut back, decreased, and now, retirees are seeing benefit cuts. So there really is no more money in the system. And if we want these plans to survive, and if we want the employers and the jobs they create to survive, we think a loan is the best way to do that. I will say we see it as one part of the solution. We are looking for a comprehensive solution that does help the entire system.
And without objection, I'd like the multi-employer pension reform principles of 2018 to be included in the record. Ms. Moorkamp, you have also, with excellent testimony, as the other panelists have offered, in your testimony, you've supported a loan program. Would you care to expand upon that?
I look at this also as a phased approach, and I support what Mr. Langen and Ms. Wong have said. Immediately, the issue before us is we have to treat the critical and declining plans. We have to stabilize the patient before we can cure the disease. There's no contribution increases, benefit cuts, or investment returns that will make these plans solvent. We do believe federal support is needed, and that the best way to do that is with a long-term, low-interest rate federal loan with the appropriate measures put in place to ensure repayment. And then we would look to overhaul the entire system to take into account the current economy, the mobility of workforce today, and changing demographics.
Thank you. My time has expired. I recognize the gentleman from Tennessee, Dr. Rowe.
Moorkamp, your testimony can be placed under the let no good deed go unpunished rule. The solution, and I've listened to these now for years, is not complicated. It's increased PBGC contributions, decrease planned benefits to people that are already out there getting it. That's been passed 3.5 years ago. Stop new members, as Mr. Blackman said. Don't add any more people to create the problem, make it worse. And then a loan or a bailout or whatever you want to call it. I think that's the options that we have. And the fifth option would be to do nothing. So those are our options. And we can argue about how to do it. And I guess my question is, since the PBGC's only had one loan ever paid back, how do the taxpayers, I'll put the taxpayer hat on, how do they get their money back? How does a failing plan, I'm still trying to get my arms around how when you can loan a plan money that's grossly underfunded, that it can pay back a loan that's made, as Mr. Neal has pointed out. How can that happen?
I will answer that, Mr. Rowe. Part of our proposal, and I'm not here to sell either proposal or anything in that regard, but one of the aspects of our proposal does unfortunately include benefit modifications. And we feel that it's important to take a look at the entire plan, stabilize the cash flow, and in an effort to ensure that those monies are paid back, there has to be some source of new income coming into the plan. One way to do that is through benefit modifications, so that those reductions in the cash flow that's going out the back door can be reinvested back into the plan. The liabilities that are in the plan today will be lowered, and if you do it over time and draw it down over time, the assets have an opportunity to grow back.
Is there, is there a number out there? Because you've got a lot of people out there that are dependent on this for livelihood. Is there a number? Is it, we talked 20%, 10%, 50%? I mean, there is a number out there that will leave you enough money to do exactly what you just said. But what is that number?
What we have modeled, working with all the large plans, Central States in particular, and several other plans, is we feel that benefit modifications up to 20%, not a flat 20%. There's a lot of ways that you could skin this cat from a standpoint of how you recognize or give the loans, whether you give them monthly as a lump sum every year or every 5 years. The more money the plan has an opportunity to make asset returns helps the situation, but you can design the loan to reduce the amount of cuts that are necessary in order to repay it.
And we haven't done away with the economic cycle, so there'll be another recession. I mean, the economy's doing great right now, but look, I've been through a bunch of them. We'll have another recession somewhere along the line. Is that factored in?
That's a very good point. And one aspect of our proposal that's different from some other proposals is we propose loaning the money over time, a monthly loan, to avoid risks in the market, to where the downturns in the market. If you give a plan several $1 billion up front and they lose it in the market to no fault of their own, just to decline, that's going to create a problem. We'll be right back here. So if you give it over time, they can weather the ups and downs of the market itself, while the modifications are still there trying to grow the assets back.
Do we have that? Have you laid that out in a proposal where we can be seen, modeled?
Yes, we have, sir.
Okay. And I guess the other thing that I didn't add to it was Mr. Norcross and I have a plan going forward. Mr. Blackman, we have a 401k in our office, in our shop, but this GROW Act that we have is certainly another option that could be number 5, to stop putting new people in and then begin doing exactly what you talked about, continue to pay the legacy liabilities, but enter new people into this new plan, which gives you the blend of both defined contribution and defined benefit.
Yes, and I don't pretend to be an expert on that proposal, but from what I understand, the new pension part of that actually looks a lot like the pension that we signed up for in 1971, the pre-ERISA plan. Now, of course, we're all here because that plan, the rules were changed. So I guess as a small business owner, I would say if you gave me the option to opt into that, I would respectfully decline. It's my understanding that today's Congress cannot tie the hands of a future Congress, and we have a history of Congress changing those rules exactly like that in the past. So that's why my preference is for a pure defined contribution component, no pension promise whatsoever.
Well, that's the plan I live with. It's what I have myself. I yield back.
Thank you. The gentleman from Virginia, Mr. Scott, is recognized.
Yeah, thank you, Mr. Chairman. Mrs. Wong, we've heard a lot about the taxpayers' interest in this. Can you tell me what interest the taxpayer has, especially if we do nothing, what the taxpayer may be on the hook for?
Yes, our concern is that there's a huge liability out there now, but if we don't do anything, that liability will grow. And although the taxpayer isn't technically on the hook for the PBGC, I think we can all agree that we don't think Congress will stand by and do nothing if the PBGC goes bankrupt. And it's really a question, it's not a question of if or when, it's not a question of if, but of when. And so if we can address this issue now, looking at it from a taxpayer perspective, it seems more responsible than waiting until the problem's even greater.
Are you suggesting there's a moral obligation to make sure the PBGC pays what it has guaranteed, even if it runs out of money, that we have a moral obligation to replace the money?
I think Congress will have a political preference to make sure the PBGC pays those benefits.
And we'd be on the hook for other things like people aren't getting pensions and not paying taxes?
And I don't have those numbers in front of me, but I can get them. There have been studies done talking about the loss of pension benefits and the impact that will have on the economy. And those losses will be made up somewhere, and we think they'll be made up on the public services.
You mean like safety net, food stamps, Medicaid?
Exactly.
And so if we don't do anything, we have the taxpayers really on the hook for, right now, unknown billions of dollars.
Yes.
Do you know how many companies may be in a situation where their withdrawal liability exceeds the net value of the company?
I do not have a specific number, but we hear from quite a few employers daily.
Ms. Moorcamp, you indicated some problems with, and Mr. Blackman talked about problems running a business with this liability hanging over your head. Is that liability, is the pension potential liability of the listed on your financial report?
I can answer that.
Okay, thank you.
On our audit reports, we are formally audited every year. The withdrawal liability is listed as a contingent liability. It's on the notes to our financial statement. It's not on our balance sheet.
Do potential creditors, lenders look at that and become reluctant to lend you any money because of that?
Well, I'm happy to say that we've had the same lender for 72 years. That lender has told us that we've earned the right to have a contingent liability. Not all of their customers are treated with that degree of trust. So I would say, though, that from a practical standpoint, it does limit our borrowing ability, because even our bank, which trusts us, they would require a personal guarantee for any large long-term loan that we would ask for. They already have a personal guarantee on our line of credit. So from an operational and a business planning standpoint, if I'm not prepared to personally pay back that loan, then I won't take it out. And what's concerning about this withdrawal liability is that it seems to be an uncontrollable figure. So to my mind, the risk associated with taking out another long-term loan is prohibitive.
Thank you.
Scott, can I
Yeah.
fill in as well? Our lenders have told us that when assessing our credit quality, our lenders, as well as our rating agencies, are adjusting our credit statistics to take into account our unfunded pension liabilities, which leads to higher interest rates and higher cost of capital. And anecdotally, we do understand that there are rating agencies that use a withdrawal liability number, and then they either increase the liabilities or reduce the EBITDA by a percentage of the withdrawal liability, and either way, it leads to a higher credit risk and a higher cost of capital.
Thank you. And let me follow up. I think you indicated, Ms. Moorcamp, that you pay what's negotiated under the collective bargaining agreement. Is that adjusted to reflect what is needed to keep the the pension fund solvent?
So we have a negotiated contribution rate, but we have plans that are under rehabilitation plans, and there are funding increases that we have seen as a result of that, some as high as 225% over what they had been prior.
Thank you, Mr. Scott. The gentleman from Florida, Mr. Buchanan, is recognized.
Thank you, Mr. Neal. I appreciate the opportunity. I want to thank all of our witnesses. We've got great companies, smaller companies, UPS. I was involved with the U.S. Chamber for 8 years on the board, so I appreciate you being here today. And I was in business for 30 years prior to coming to Congress and had a lot of employees and everything else. But I grew up in Detroit. My dad worked in the factory for 30-some years, paid into a stock program. At the end of 35 years, ended up with zero. And one of the concerns I've got is just the precedent we're going to be setting here for everybody else. The second thing is the idea of loans. And there might be a combination. I'm a possibility thinker. I'm sensitive to businesses as well as them. But we're moving the liability, not all of it, but a lot of it, from companies and stakeholders to the taxpayers or other people. I mean, we're going to put it on the balance sheet of the country. And we do a lot of that already, Democrats and Republicans, so it's unfortunate. But I guess when I think about, I was born in Detroit, grew up in Detroit. I use as an example, fourth largest city, went bankrupt. All the stakeholders had to make adjustments and haircuts. And I guess I'd want to know, I want to put this in the right light, you're going to benefit quite a bit by us doing this. If you have equity in companies, if you have shareholders, you're benefiting because you're removing that liability. Let me just ask you, everybody needs, in my sense, to come to the table. It's a restructuring, a reorganization, other than just the American government. What is the business community willing to do in terms of their share, or they feel their sense of responsibility? Because it is going to make a big difference. I know that if we didn't do anything, the smaller companies, if you got loans, you put maybe everything you've built at risk going forward. But I think everybody, my sense, has got to step up and be a part of the solution going forward. So let me ask you, in terms of the business community, what are you willing to do, or what have you given thought to, short of the government just stepping up and fixing the whole thing? Mr. Langdon?
That's an excellent question. In looking at the whole perspective of the problem, we looked at all different ways in order to solve this. One of them was increasing employer contributions. Could we raise the contribution enough in order for the employer to fix the problem in these plans that are in trouble? If we go back to the enactment of the Pension Protection Act, most, if not all, of the plans that are out there have seen the employers double their contribution rate over less than 10 years. And that, a lot of that is due to the rehabilitation and the funding improvement plans that are out there. So we do feel that that has already occurred. Some of these plans are asking for anywhere of 6, 8, and 9% increases in their contributions, and the employers that are remaining in there are obligated to pay those because it's part of the collective
And let me
bargain.
just say, because I'm going to run out of time, that when I started my first company in Detroit, we had a profit-sharing plan for everybody. Then we went to a 401k. A lot of people went to the pension plan. But with pension plans, like city government, state governments, and everything, there's risk. And we had talked about this before, about what happened in 08. The market dropped 38%, the S&P. So there's risk when you get into these plans that companies and unions and others make those decisions, and you have a fiduciary, but nobody could expect that. But in the first decade, just to think about that, the new century, for 10 years, it was zero return. And if you've got a 50% equity portfolio, you've put a lot at risk. Ms. Wong, just in terms of what is the business community willing to do instead of looking to the government for everything?
Well, I would just like to reiterate what Mr. Langen said. The business community has already increased contribution rates. They've increased their PBGC premium rates. They've been assessed withdrawal liability, either partial or complete for those who could pay it. So even at this point, and if you read our principles, we're not saying that there should just be a loan program. We're saying everybody needs to put skin in the game. And it's not that the business community is waiting for Congress or for someone else to resolve it. They're looking for partners to help them resolve it.
But you understand, equity owners and shareholders of all these companies, big and small, benefit if we write a big loan in terms of that. Ms. Moorkamp, do you want to just respond? Your thought, you got two smaller companies, but what is the business community willing to do to make this deal?
Well, I echo again what Mr. Langen and Ms. Wong have said as to the burden that the employers have been carrying. But I want to get across, I am not here today to ascribe blame. No one here is to blame, not the contributing employers.
I'm not looking to assess blame. I just want to assess the
It appears
idea.
that way, and we think seriously that everybody, no one here is to blame, and everybody is going to have to share in the sacrifice of what needs to be done, first and foremost, to save these critical and declining plans that are facing insolvency.
Mr. Blackman, anything quickly?
Yeah, all I'd say is that, from my perspective, we have a yellow zone plan. Personally, I'm not asking for a bailout of any kind. I want an exit door. I want to stop making new contributions. I want to stop making new promises.
Thank you.
And I need Congress to help me with that.
Thank you, and I yield back.
Thank you, Congressman Piana. Senator Manchin.
Thank you, Mr. Chairman. First of all, let me thank all of you, and I want to thank our chairman and the ranking member for holding this hearing. And we've got to start coming up with some solutions. But as you know, I'm very focused on solutions of a multi-employer pensions crisis. So I was glad to see that Senator McConnell gave us a few extra weeks of time to work this August. We should be staying here on Mondays and Fridays too, but I mean, that's a bridge too far. I encourage my colleagues on this committee to use this time to come to the table and seek bipartisan solutions. I would also note that I am very happy to see our brothers and sisters here from United Mine Workers, from my turf, if you will, people I grew up with, and I appreciate the hard work they're doing. I hope they continue to come back, because I can tell you, when you put a face and a human being with a problem that we have, then we can find a solution. You've heard me say it before, and I'll keep saying it. The UMWA 74 Pension Fund is the first that will fail if Congress does not act. And if or when the UMWA fund would fall, and if we don't find a solution, the others will start to tumble. This plan is expected to become insolvent by 2022, possibly even sooner if we see a market downturn or additional coal company bankruptcies, which are not that unlikely. And while the pensions provided by this plan are small, to give you an example of what we're talking about with the UMWA pensions, an average of just $595 a month. $595 a month is what we're talking about for the UMWA. They are critical for retired miners and families who rely on them, and mostly a lot of widows. If this plan goes under, these families and the communities they live in will be devastated. So I hope that today's discussion will demonstrate for everyone exactly what will happen to American businesses and communities, to our poverty services, and to our national economy if these plans fail. But I also hope that all you witnesses will offer us more ways to address the crisis, and we're not putting any blame. But let me make sure you understand. The working person in America, the United Mine Worker, and anybody that's ever done any hard work is not to blame at all. They didn't set their rates of contribution. They didn't set the plan. They weren't there when basically the bankruptcy laws. It was all done usually here in Congress. That we've set basically the slope, if you will, of what would happen, and this is what we're dealing with. They weren't responsible for the 2008 financial crisis. They weren't responsible for the lax oversight of the large banks. None of this was their fault, but they're taking all the hit right now, every one of them. So I'll start with Mr. Langen. What is Plan B, sir? What do we do if we walk away from this? What happens?
Well, as was mentioned earlier in Ms. Moorcamp's testimony, walking away in failure is not an option to this crisis that we face. We've got to figure out a way to stop the cash flow that's going out the back door and stabilize these plans and give them an opportunity to return back to health. Because if we don't do that and we just allow the system to fail, then what's going to happen to the remaining employers is unknown at this point. If a company or a plan is not in, for example, in compliance with the rehabilitation plan, are they now facing funding deficiencies? Are they now going to face a mass exodus out the back door from the employers and the risk of mass withdrawal? If you have a mass withdrawal situation come, contributions stop, accruals stop, and now employers are assessed withdrawal liability, which now is put on their books. You put a liability on your books that's greater than the value of your company, you're never going to be able to get out of this. So letting the system just fail and hoping the PBGC can give a little bit of a benefit is not the answer. We've got to get cash to these plans and figure out a way to pay it back so the taxpayer is protected.
Ms. Wong, if I may ask you, with the reduction of our corporate tax from 35 to 21%, that 14% savings, has it put a hardship on our corporations and businesses now since they have this extra relief? If they do contribute more, I know you all just talked about contributions, but would that put an undue hardship?
Does the tax cut create an undue hardship?
I'm saying if I asked you to give a little bit more back.
Oh, I'm sorry. The tax cut. Well, obviously, the tax cut helps with the businesses.
Sure.
Providing.
You never expected to get 21, did you? You'd have taken 25 in a heartbeat.
I won't answer that one.
What we're saying is none of us want to put undue hardships and create more unemployment. But is there enough room in there to help the PPGC? I know there's going to be an awful lot. The only thing I'm asking for has got to be a floor. You can't ask a widow getting $595 to take a 20% cut or a 10% cut. And we have to have skin in the game, but there's got to be some compassion and some understanding of the economics we're dealing with here.
I appreciate that. And again, I would reiterate, employers already have skin in the game and have been putting skin in the game. We understand workers and retirees have all been putting skin in the game. So It's not an easy solution, but we are asking that, again, we all have to come to the table and resolve this together.
And my time is up, and I'll save it for the second round.
Thanks, Senator Manchin. Congressman Schweiker.
Thank you, Chairman. Isn't it fun reaching over and calling you Chairman? It's,
Yeah, sure.
yeah, okay, that too.
Might get used to that.
All right. Ms. Blackman, a couple moments ago, you actually mentioned the desire to leave.
Well, I should specify, I would like to make new contributions in a defined contribution plan.
Yeah.
No more new contributions to the defined benefit. I'm perfectly willing to pay my existing obligations to the defined benefit.
Okay, and so there you'd led me to. So what is the existing obligation? For many of us, when we've actually been looking at the math, we think actually we'll call it the severance mechanism, isn't actually properly calculated for the true liability.
I would agree with you.
Okay, in that case, you're my new best friend, you just made it easy. Ms. Wong, if I came to you and said, okay, in my understanding, the Chamber prefers sort of a loan mechanism.
Yes, we see that as an important part of a resolution.
Okay, so as we heard another member of the panel a little while ago saying, protecting taxpayers, those things. Do you think all the businesses would be prepared to also sign a promissory note? So they also carried some liability for that loan?
I think the businesses feel like they already have a promissory note.
Well, yeah,
They're
but if we're going to do a loan document to make it very clear that they carry the actual liability.
Yeah, I will take
How
that
about
back to my membership. I don't.
how about a mechanism where if they filed bankruptcy, that this is a top-tier obligation, co-equal to other bonds, because this is, their pension liability. Now it's a loan obligation, if it were done mechanically as some of the proposals here, to the U.S. government. Can we make it a top-tier bankruptcy?
Could I speak to that? I think
I wanted the Chamber, partially because at one level, if you're asking to socialize the risk, okay, but if you're saying, I want to socialize the risk at the same time because it's going to protect taxpayers, let's protect taxpayers.
I appreciate the concern. I'm not sure if that's allowed under bankruptcy law, but.
But we can always rewrite the law. That's what we're here talking about.
I agree with that. And I am happy to take that back to our membership and discuss that with them.
Okay,
We are
but
open to-
don't you think that's in some ways that we're going to talk about everyone having skin in the game, and we're doing it fairly, and we're all taking, obligations? Because I know there seems to be an attempt here to sort of, we're all dancing with a hot potato and pushing and trying to socialize the risk, but not take it ourselves.
Employers are taking the risk. I mean,
Well,
they're the ones
if they're-
paying
if-
into the
if-
plans today, and they're the ones with the risk of going bankrupt.
Well,
if
but
there's
if
not
you
a
actually think
resolution.
about what we were just talking about before with Mr. Blackman, okay, so if I leave, I'm probably not paying my full actuarial value for, let's say, my stranded lives. And that's both a concern, and then my obligations if a participant were to go bankrupt, even though we had created this loan mechanism, we need to make sure that those obligations, so you can actually see just from a credit management. And Mr. Blackman, before I had interrupted you.
I'm sorry, it sounded like you were talking about changing the bankruptcy hierarchy of creditors.
Well, it's an honest discussion. If we're all having, one of the reasons we see such high levels of underfundedness is industry concentrations, and within those industries, we saw cascades of reorganizations and bankruptcies, and within those, movement away from these obligations because they were discharged through bankruptcy.
Right. And
How do we move that up so as a society we make pension obligations a top tier?
I understand. You have to keep in mind that because the way the bankruptcy hierarchy is structured today, that's what allows my bank to essentially not hold me accountable for that withdrawal liability today and still grant me credit today. If we reverse that and pensions come ahead of banks, we're done. I mean, we're out of business.
Well, but there we're back to the socialization of the obligation for that. Your business is back on everyone else. And look, I'm not thrilled with this, but all of us are trying to have intellectually honest conversations of how many levers do we actually have. And the more I read, the more I realize a lot of my levers don't produce a lot of resources. So as we're going to actually continue the conversation of some type of financing instrument, okay, who's going to help us guarantee other than the rest of the taxpayers?
Representative Schweiker, can I just inject very quickly, please?
Very quickly.
Changing the bankruptcy laws is not going to solve the problem of the 130 plans that are facing insolvency.
We didn't say it would, but
I know,
actually,
but-
no, stop. But once again, if you're asking to shift it on to the rest of the taxpayers, shouldn't the rest of the taxpayers also have you take on some of that obligation? With that, I'm sorry, I'm beyond time. I yield back, Mr. Chairman.
Certainly finish your answer, Ms. Moorkamp. We treat witnesses well in this committee, so go ahead.
So I was just going to say, I would be very careful, to your point, of changing the bankruptcy laws, because that could make it much more difficult for us
Well,
or other employers to get credit.
If the chairman will let me
in matters
reclaim
where-
time then, but also so would signing a promissory
Senator,
note,
but-
because you'd be carrying that on your books.
Ms. Moorkamp, please finish.
Well, she just did.
Okay, I couldn't tell.
Thank you, Mr. Chairman.
Sure. Senator Heitkamp.
Thank you, Mr. Chairman. I think every person testified as a given that benefit cuts would have to be part of this. I just want to put on the table that we have, in fact, advanced a plan, and I think both the Chamber and UPS have suggested that a loan program could actually, a long-term loan program could actually be part of this solution. I think it's really, really important that we set a ground rule that where I'm really committed to fixing this problem for our small businesses and workers and retirees, I don't accept right out of the chute that we'll have to lead with a benefit cut to solve this problem. And so, we're going to continue to look for solutions, but I think it's really important that that we recognize the need for shared sacrifice, but that we try and lay down a marker. I'd like to mainly address the question of withdrawal liability. We've heard compelling testimony, I think, today about the cost of doing nothing, especially for Main Street businesses. In the Central States Pension Fund, pretty much the only businesses that are left are, in fact, small businesses. About 90% of contributing employers have less than 50 employees. I want to tell you a story of one of those employers based in Fargo. Recently celebrated its 100th anniversary, been employing people in my state for 100 years. For 100 years, the business has played by the rules, contributed to economic prosperity of our community and our state, and provided that employment opportunity. And for over 60 years, it's made contributions to the Central States Pension Fund. Yet, for 2017, the owners tell me that their withdrawal liability number is about $7.4 million. That's up from $5 million in 2015, and that's to cover 21 people. It's overwhelming, and it is frightening, and it is terrifying small businesses all across my state who are still part of this program. So can you walk me through, and I'll throw this out to anyone who wants to answer, can you walk me through how this withdrawal liability might affect access to credit and capital, employee hiring decisions, and business investments for any firm? And what are the risks to employers participating in critical and declining plans such as Central States if accounting rules require contingent withdrawal liability to be recorded on the balance sheet? So right away, we go back to access to capital. You put that on your balance sheet, I don't know who's going to give you money. And that goes back to the question I think Mr. Schweitzer was getting at, which is this is very complicated. And it affects not only solving this problem, but bankruptcy, access to capital, and small business development. So, Mr. Langen?
Yes, thank you. From a withdrawal liability standpoint, there's one thing we have to keep in mind. Withdrawal liability occurs when you're going to withdraw in the simplest form. Your obligation to the plans is what you collectively bargain. So that's your, per se, liability that goes through your...
Mr. Blackman wants to get out, so let's just,
Okay.
he wants to withdraw, but he can't afford to.
I understand that, and we have withdrawn from a couple of plans ourselves, and we did pay the amount of the withdrawal liability that was required under the calculation. It's a financial decision for the company, but to your point, it is disclosed in the footnotes of the company today, so it is out there. And then once you ultimately do withdraw, you do have to book that on your balance sheet.
But how do I, as a senator from North Dakota, tell this small business who has 21 employees that it's reasonable to assume his withdrawal liability is over $7 million.
Unfortunately, the way the law is written today, that's how it's calculated. I can give you an example of a plan we were in. We had 2 employees, and the liability was $5 million. So it's a function of how the math works, and the way the law is today, it's spelled out very clearly how the withdrawal liability calculations are determined, unfortunately.
I want to make this point. So responsible employers who have provided this defined benefit plan and who haven't taken advantage of the bankruptcy exit now are holding the bag. I think that's a fair characterization of what's going on. And so, when you say don't change the bankruptcy laws, I agree that will create a huge amount of disruption in changing the queue on who gets paid first. But it also means that everybody who is the last man standing or the last person at the end of that ladder ends up with all the liability. And that fundamentally, just as it is not fair to these workers that they played by the rules and did everything right, that they're getting cut, it's not fair to these employers and these small businesses to be stuck here in this position. And I understand that we've got to balance this, and we've got to realize or think about what the government's role should be. And so, I've wasted, probably didn't waste, I didn't get a lot of questions here, but I wanted to just make the point that the employees are incredibly sympathetic, but so are my small businesses who are challenged with this problem. And we've got to come up with a solution that solves this for everyone.
If I could add just one quick thing, I won't take long. I think one way to look at this, the employers that have remained in the plans, we've actually acted as the PBGC in these plans because we absorbed the liability.
Senator Portman.
Thank you, Mr. Chairman. I'm going to first talk about something general, which is that there's been discussion here when I was here earlier, and I understand even in my absence I went to vote about, who's for what, and, you're for loan programs or not. And I just hope we don't take things on and off the table. I think we need to keep everything on the table at this point. We have a huge problem ahead of us. And I know there's been discussion about having a hearing here where we talk about solutions. I'm for that, but I want to be sure we have the data to be able to do it. So I would hope that if we have a hearing about data, that we have, about solutions, that we have the data and information that we need, particularly an analysis from PBGC and from CBO on the options. So a lot of us have requested that for the last several months, and we still don't have the numbers that we need to be able to, I think, make important, informed decisions. Ms. Wong, I want to ask about some of the rules here, and one particular one that troubles me, which is the convoluted rule that could actually result in hundreds, maybe even thousands of employers, particularly small employers, going bankrupt if this isn't addressed. And that's what you talked about a little in your testimony, the uncertainty regarding minimum funding considerations. We talked in the last hearing about this, and we talked about the fact that employers in healthy plans have got to meet their minimum required contributions every year based on new promises they've made to new employees, promises they make to current workers, particularly in addition to any accrued deficiencies they have in the plan's funding standard account. But once that plan goes into critical status, that changes, doesn't it? And I think it's something to focus on in terms of the law, and maybe an inadvertent but a potentially negative consequence, because then the trustees are required to come up with this rehabilitation plan, which can include exempting them from needing to contribute their required contributions, at least under normal accounting standards. And additionally, employers have the excise tax liability enforcing payment of these minimum required standards, minimum required contributions waived as well. So once you go into that status, it changes. And for employers in central states, my understanding is that employers are currently paying less than half of what their minimum required contributions are, as an example. At least what they would be doing under normal accounting standards. And once that plan becomes insolvent, it might no longer technically be in critical status, right?
Right.
So
that's the uncertainty, exactly how
what
the rules
happens
work
there?
together.
I mean, it's unclear to me, looking at the legal part of this, the actual statutory language. What happens with the excise tax then? We asked Joint Tax Committee about this in anticipation of this hearing. We've heard that Treasury has never issued guidance on this issue. The statute's ambiguous. And I think it's enormous uncertainty and a potential for a catastrophe for a lot of businesses. So you noted that a multi-employers plan must satisfy certain code provisions, the rehabilitation plan, and you said that if a multi-employer plan fails to make scheduled progress under the rehabilitation plan for 3 successive plan years, or fails to meet the requirements applicable in plans in critical status at the end of the rehabilitation period, for excise tax purposes, the plan is treated as having a funding deficiency. Let's translate this a little bit just for our purposes today. It looks to me like once an insolvent plan can't show improvement or meet rehabilitation plan requirements, when Central States becomes insolvent, doesn't that mean that employers would have to meet their minimum contribution requirements and possibly pay excise taxes?
And that's what the law says. So.
How does that
and
make
let me
sense?
take the purpose of the rehabilitation plan was to allow and to give plans time and employers time to make those plans whole again and make them solvent.
Mm-hmm.
The concern is that, and again, we were involved with PPA and making that happen. We didn't foresee what would happen in the time before that. And so the thought wasn't given what would happen if there was an insolvency at the PBGC, what would happen if there was a major plan insolvency that would impact those rehabilitation plans or the entire system like we're facing now. And so I think it was an oversight in terms of how those rules work together. In the report we issue today, that is what we point out, that legally there is the ability for the IRS and the PBGC to come in and reimpose those minimum funding standards and the excise tax. If it will happen, we don't know. Because
Aren't you really saying that you're hoping that the IRS does not enforce the law, that they don't read the letter of the law, and which would require massive contributions and the potential insolvency of hundreds of businesses, just in Central States example?
We think it's unclear. And that they can come in and assess it, but it is unclear about how and when or if they could do that.
Mr. Langdon, how would uncertainty regarding a possible funding deficiency crisis affect the mass withdrawal possibility?
A mass withdrawal is defined, it's not insolvency that creates a mass withdrawal. It's when all of the employers leave or substantially all of the employers leave, or it can be triggered by the trustees making that decision.
But this could be a result,
Yes,
right?
it could.
Yeah.
What will happen, in essence, that a lot of folks are concerned about is people will start leaving. They'll see that there's no benefit for their participants that are in the plan. They'll see that there's no hope this plan is going under, and they'll start heading to the exits at
Which
that
would
point.
lead to the meltdown of the entire multi-employer system, probably.
Yes.
Yeah. Anyway, I think it's something we're going to have to address as part of whatever solution we come up with, certainly at least adding clarification to it. Thank you, Mr. Chairman.
Thank you, Senator Portman. This is a sort of what happens if we do nothing hearing. And I think the four of you have done a good job explaining. I want to kind of step back and ask you sort of generally where you think your member companies or individual companies go. Start with and go into this in greater depth. Ms. Wong, describe the impact on member businesses if Congress does nothing, and describe what happens in your view in the economy. Quantify as much as you can the impact inaction would have on businesses and the general economy.
So first, I want to emphasize that there are already impacts being felt today. As we've discussed with the withdrawal liability estimates, companies are already feeling impact from that in terms of their credit lines and creditworthiness. You're seeing problems with employee retention because of the high contribution rates and because those employees aren't getting the accruals that are commensurate with the contribution rates. So we're already in a process of seeing the impact, and as we go forward with this and as the crisis worsens, these issues will worsen. So we can see, as we've talked about, if people try to withdraw from plans, their withdrawal liability is going to be even greater. There could be mass withdrawals that they have to contend with so that those liabilities are even greater. The minimum funding rules and excise taxes could also be an issue. Any one of these things, all of these things could cause employers to go bankrupt, definitely cause them, impact their business in terms of their ability to expand their businesses, provide jobs, and to continue working in the most efficient way.
Mr. Langen, understand, I just spoke with Senator Isakson a moment ago between votes on the floor about your testimony, and we were just talking about what you did a decade plus ago when your company did the right thing, but your liabilities, some of it obviously still stands. What would be the impact on UPS, on the plans that it's still a part of, and other businesses that participate in these plans if Congress does nothing?
Our concern is that the pressure that will be put on these plans for raised contributions, not only on us, but the remaining employers, the small employers, will start driving them out of business. And we're in these plans together. They can only go out of business once, and our ownership of these plans will just continue to grow. And there's the last man standing rule out there that we could eventually be the last man standing in some of these plans. And the contribution rates that we're putting in are very, very high, and north of $20,000 per participant in every plan. And they're not getting the benefits of those monies in some cases, and it's just going to be continued absorbed liability that we're facing if we stay in these plans.
Thank you. Ms. Moorcamp, what would be the impact on your company if this committee fails and Congress doesn't enact legislation?
Well, I'm here today, and you are here today to ensure that doesn't happen, because failure is not an option.
Well, I agree with that. I've said that many times, but I don't know that Congress yet understands and the public yet understands what failure would mean. So can you dig a little deeper and tell me what would happen in your company with your employees and your businesses and your suppliers and all?
I have no idea what's going to happen when a plan of the size and scope of Central States goes insolvent. I don't know how our lenders are going to react. I don't know how our auditors are going to react. But again, Senator Brown, I, for one, am not willing to just wait and watch it happen.
Okay, thank you. Thanks for being here and saying that, Mr. Blackman.
Yeah, I think I have some idea what would happen to us specifically. If Congress does nothing, I expect the Boilermakers plan will continue to decline. That's because I believe the actuarial assumptions are not reasonable. So what I would expect to have happen is our contribution rates will continue to climb. Our withdrawal liability will continue to climb. So as contribution rates go up, we continue to get less and less competitive. At some point, we are at the point where we may not survive the next recession because under recessions, margins get squeezed. If our costs are too high, we lose money. We don't know how long that's going to last. Nobody likes to see that much red ink with an indefinite end period. If the withdrawal liability keeps getting bigger, then I think at some point my bank would likely say, you know, up to this point, we've had confidence in you, but it appears as though this is out of control, and we are now concerned that we need to start limiting your credit.
Thank you, Mr. Blackman. Ms. Long, last question. There have pretty much been two proposals around this. One is the Butch-Lewis Act, and there has been some bipartisan support in the House on that, not yet in the Senate. It's on the table, but as Senator Portman suggests, everything should stay on the table as we discuss this. The other is the plan that Congress should raise PBGC premiums, keep the agency afloat, and maintain the insured benefit levels for participants. Is that inadequate, and if so, why?
It's inadequate as the only solution. Not only is it inadequate in not saving the plans, it could also push more plans into insolvency or at least into the critical and declining status. So we definitely don't see that as
Because of the increase in premiums.
an increase in premiums as a solution. And we would even offer that raising premiums shouldn't be looked at until we address really the insolvency of the system or these issues in the system to see really the impact that changes have and whether those premiums and how much those premiums still need to be increased.
Thank you, Congressman Norcross.
Thank you, Chairman. And I want to thank the employers for trying to do the right thing, and that's to provide for the golden years of your employees. That's the way you say thank you. Bankruptcy has been mentioned a number of times, and the position of our pension system. Pensions are deferred wages. They have been put aside out of the regular paycheck so you would have that opportunity to retire with dignity. I have a bill, and Senator Brown, along with Dick Durbin, has to address this issue because years ago, it used to be in first position with wages. I understand there would have to be a transition, but bankruptcy has shifted that responsibility from an employer to the employee. And quite frankly, the conversation that you're having, Mr. Blackman, is a defined benefit. The risk is with the employer. When times are good and you're getting tremendous returns, your contribution goes way down. Inversely, when times are bad, it goes up. When you go to a defined contribution, you have now shifted everything away from the experts and makes every individual employee an investment firm. This is the risk that goes in. And that's why Dr. Rowe and I have put together a hybrid plan. That is completely voluntarily. But I want to address a couple questions here. Ms. Langdon, when Central States faces their ultimate desire to stay in business, but the numbers, because of the pension plan, which is declining rapidly, come in, I understand there's 3 different options that can take place. Insolvency, which is PBGC pays in, and that $12,870 is the maximum anybody can get. Mass withdrawal, which you talked about, and to go to the question that came up, can't we force them to pay? We'll just drive the employer to bankruptcy, and then they walk away with nothing. This is history, and each one of these rules has a reason for being there. This isn't a red or a blue issue. This isn't a suburban or urban issue. This is an American issue. Every one of us has retirement plans that we look forward to one day. Take that away from us, what you earned is what they earned. It is not only our job, it's our obligation to try to fix this. And the only way it gets fixed if we come together. So there is a term that is used to address some of the funding issues, pension smoothing. They do it without a loan. Would you address that issue and how we've turned it into Butch Lewis or Butch Lewis #2, address how that takes away the additional income and lets us, quite frankly, invest in Americans so it keeps the plan from going under?
Well, the smoothing method, I believe that you're referring to, is an actuarial method that takes the gains and losses of a plan and it smooths it out over time so that you don't have spikes and valleys in the valuations as you're going forward. It's used to, because these plans are a long-term view, they're not a tomorrow-type view. It's used to stabilize it so that the contribution rates based on the assumed returns can be met. I think one of the points that you made in regards to the PBGC and the levels that the PBGC is at, and I'd like to just take 1 second to address that piece, because I think the thing we have to keep in mind is as we're addressing the PBGC, they have a $65 billion+ liability out there as well. So the question really is, do we move money over to the PBGC or do we get it to these plans so they have the cash flow so they can smooth their way out of this into the future?
Absolutely. When we look at the underfunding from Central States, it is, what are they, $38.9 billion. The 10 plans or the 9 plans behind them takes it up to $76 billion. So this is the issue that we're dealing with.
If I could add one other thing, I don't mean to interrupt, sir, but I wanted to add one other thing. If we just look at the PBGC levels in regards to Central States, and they're going to go insolvent in 2025, 2026. They've publicly said that. The PBGC levels, in order to come in and step in and provide that benefit, it's going to require about $700 to $800 million worth of cash from the PBGC just to help with that lower benefit.
How much would you have to raise the premiums in order to cover that?
Over 800% at a minimum in order to solve that.
What, 800%?
800% in regards to what we're paying. It's not sustainable. It's just not really a viable option.
So the cost of doing nothing to our great country far exceeds what we need to do. I yield back.
Senator Smith.
Thank you, Mr. Chair, and thank you so much to all of our testifiers today. You know, I probably have met with hundreds of Teamsters in Minnesota and North Dakota with my colleague, Senator Heidkamp, and I've also talked with a lot of employers. And, you know, just last week I met with a Minnesota employer. It's a family business, close to a 100-year-old business. Maybe some of you can relate to this. And they are looking at the shadow of all of this on their balance sheet. They're ready to pass the business on to the next generation, and they can't figure out what to do. And this is a really proud family business. They're proud of what they've done as responsible employers, and also they're proud of their family legacy. And, I'm here to say that I've talked to a lot of employers and a lot of employees, and I have never heard employers cast blame on the employees or vice versa. There's a lack of blame in that conversation, and I think that ought to be a motto for all of us. And I appreciate so much then that, the tone that you're bringing here. There's been a conversation here about the risks of inaction, which I am very attuned to. And so I want to just ask you, there's also been some discussion about, though some would argue that the loans that some of us, the idea of a loan strategy that some of us on this panel have proposed is too risky to the taxpayers, doesn't share the risk. Would anybody just like to comment on that? How would you respond to somebody who says that the loan strategy is too risky?
Well, I think that when you're looking at a loan strategy, you have to look at mechanisms first, how it's going to be paid back. Because the definition of a loan, obviously, it has to be paid back. So that's step number one. But there's also another thing that we can do if we draw these loans down over time. We can create what we've referred to as a risk reserve pool. And this risk reserve pool is money put aside over time. It can be housed either at the DOL or the PBGC, and it can step in when the loan repayments start occurring down the road and help backfill that if any of these plans have a hiccup due to the markets or whatever. So if we do both, have a little insurance pool over to the side to ensure these loans are paid back and have the proper mechanism, whatever that may be in the end, to ensure it's paid back, I think loans are very viable.
But that's a way of mitigating the risk. Does anyone else want to comment on that? Ms. Wong?
Yeah, we haven't come up with a specific proposal.
I appreciate that.
But we do appreciate the effort that UPS has done, obviously, and are looking for something that can also be paid back and is fair to the taxpayer.
Yeah. So related to that, there are some who argue basically that although maybe it's not anybody's fault, this is essentially the problem of the businesses and the employers that are in this situation, and that they're kind of questioning what is the stake of the public in solving this problem. How would you respond to that? I mean, what are the risks if the public doesn't engage here?
So as we're talking about employers, I think one of the things we've left out is that a number of employers that are participating in the multi-employer system don't just have union employees, they also have non-union employees. And so the jobs we're talking about impact all employees. It's not just one or the other. Also, a lot of these employers also participate in single employer plans and 401k plans. So if we're talking, if these employers are going bankrupt or they're having cash shortages, we can be impacting the retirement security of those workers as well, even outside of the multi-employer system. And then we do have the catastrophic instances where if you have businesses going out of, or companies going out of business, the impact on the economy and local communities, obviously on that business itself and the jobs it creates.
So there's this ripple effect that's partly this contagion effect that we're talking about, impact on other pension plans, but also the impact on local communities. Ms. Moorkamp, would you like to comment on this at all? I think about your family business, the company that you run, and what you think would be the impact to the community that you operate in if something, if we weren't able to fix this problem.
Senator Smith, I'd first like to focus on the role, this contagion effect
Right.
issue or question. We are in 8 multi-employer plans. 3 of those plans, we are at least 25% of the contribution base. 2 of those 3 are critical and declining plans. And as Central States goes, those certainly are going to be impacted as well. And if you think about the different people that those represent, we also are part of the Food Association, and the 15 Food Association members contribute to 84 plans, of which 34 or 40% are critical and red. And the concern is, as Central States goes, so too will those critical and declining. And as an integral member of all the communities in which we operate, I mean, just the thought of if this is as catastrophic, what that's going to do to not only our teammates, but our communities as well.
The number of people that are impacted, and ultimately that has a big impact on all of us. I mean, certainly morally it does, but financially it does as well, because people still need to have a way to pay the rent and buy their groceries. Thank you, Mr. Chair.
Congresswoman Dingell.
Thank you, Mr. Chairman. Before I ask questions, I want to make a comment or two. Several people here members of Congress have observed that taxpayers have no interest in this issue. And I want to strongly disagree. I think first, retirees and employees are taxpayers. And this, last time I checked, they were. And we've heard much testimony about the impact the failure of a large plan could have on the economy. I would respectfully submit that every taxpayer has an interest in what this committee is going to do, what the outcome is going to be, and what the impact will be on the economy. So I want to make that point. I secondly would like to thank my colleague Rep. Buchanan for saying that I think that Republicans and Democrats need to start talking more between themselves, because failure is not an option. It's not an option for the retirees who are counting on us. It's not an option for the employers who are struggling and facing issues, and it's not an option for this economy. And Senator Portman emphasized that all options should be on the table, and I hope we are all taking that to heart. So having said that, I think I'm the last questioner. So I'm going to start with a series of quick yes or no questions so I ensure that we are all on the same page, having had a lot of back and forth. As we finish this, I want to get this on the record. So these questions are from Ms. Wong, Ms. Moorcamp, and Mr. Langahan. Do you believe that there will be negative impacts on the economy if we stick with the status quo and do nothing to help declining multi-employer plans? Yes or no?
Yes.
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 Mr. Blackman?
Yes.
Thank you. Do you support Congress doing something this year and not kicking the can down the road any longer? Yes or no?
Yes.
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 And do you support the concept of a loan program for critical and declining multi-employer plans? Yes or no?
Yes.
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 Not without structural changes.
Okay, thank you. Now, these questions are from Mr. Langan of UPS. Who administers multi-employer pension plans, and what role do employers play in this process?
Multi-employer plans are administered by a board of trustees. A lot of them that we participate in are jurisdictional in nature, so if you contribute in that area, that's where you put your monies. We're in 27 different plans. There's employer and employee representation on those boards, and on those boards they have support from attorneys, investment advisors, actuaries, and those are the folks who run the plan day to day.
So what concerns me is that I'm going to ask you another question, and I'm probably going to run out of time, so I may submit some questions for the record. Mr. Blackman said he had no input into the administration of that plan, didn't know who was doing it. That worries me. I mean, I think that there's been, well, but can you help me say who helps the governing board of trustees carry out their duties, such as determining the plan investment strategies, investing plan assets, and determining accrual levels that are supported by contributions?
Yes, there's an investment advisor on every board that I sit on, for example, and they help you set the allocation based on...
Has UPS participated in those? Have they picked the person that does it? How do people get picked for those?
How people get picked to be on boards.
Or did you feel that you had a fiduciary responsibility there?
When you become a member on a board of trustees by law, you are held at the highest standard of fiduciary responsibility. The entire board vets out and determines who is the best investment advisor. We look at that on a regular basis to make sure we have the right people, the right...
So UPS did that as a company?
As a trustee sitting on the board, as a representative on the board, yes, I have participated in that.
So building off that, in your testimony you mentioned that changing the actuarial assumptions for multi-employer pension plans would only exacerbate, not address the underlying problem. Can you elaborate on this point further? Why would this be so harmful?
Well, as far as the actuarial assumptions, what I was referring to as far as the interest rate or the discount rate, all that does is lift up the amount of the liability. The contributions don't support it. It's kind of like a three-legged stool. If you raise the liability, you either have to reduce benefits or bring in more contributions. That pressure just continues on the remaining employers, and if they can't afford it today, they won't be able to afford it tomorrow. As way of a quick example, every plan has to fill out a 5500 report, and on that 5500 report, the liabilities as far as the current liability, which is the lower discount rate that folks are referring to, is on there. In Central States alone, that added over $15 billion of additional liability to the obligation. You have to double the contribution on the remaining employers to even take a shot at reducing that liability. It's just not feasible.
I'm out of time, Mr. Chairman, but with more questions.
Thank you. Okay, thank you, Congressman Dingell. And begs the question, we will take questions, if any members, thank you for those of you that sat through this on both sides for this entire couple-hour hearing. Thank you to the witnesses. Members of this panel will have 1 week to submit questions through Senator Hatch and me that we will get to the 4 panelists. Anybody in the public that's watching or interested in this audience or anybody watching this live streamed, feel free in the next 2 weeks to submit questions to Senator Hatch and me, and we will then forward those to the 4 of you, and please respond as quickly as you can to those questions. This was very illuminating today. Thank you so
Mr.
much
Chairman,
for all of you, Congressman Scott.
Have unanimous consent request to introduce a letter from several bipartisan members of the House encouraging us to get a solution quickly for fear of devastating consequences.
Okay, without objection. So ordered. The committee is adjourned.